This is the Ask Faleskini podcast, where the modern economy is discussed from a skeptic's perspective. Mr. Faleskini helps you distinguish what is sustainable in our economy and what isn't. Not everything that glitters is gold, and not all mud is dirty. The podcaster Mr. Faleskini provides no-nonsense advice. He had it all, lost it all, went bankrupt multiple times, and is now attempting to come back from zero with sustainable growth. There are numerous coaches and preachers on the internet that preach about positive thinking and how life is all roses if you just care to see it that way. Well, Mr. Faleskini is definitely not one of them. We recommend you ask Faleskini to keep it real. He discusses the darker side of the current economic reality, the side that's more important for your personal and business finance. His first intention is to help you keep what you already have. Not to be a complete party pooper, Mr. Faleskini will also hint at the earning opportunities in the economy today. In order to please the almighty algorithm, please like, share, and subscribe. And now it's time to start taking notes. The mic goes to the podcaster, the one and only Mr. Faleskini.
Welcome to the Ask Faleskini podcast with a guest. I'm proud to present Maxwell Nee from Barcelona, Spain. Maxwell is Managing Director of Family Office Association Australia, the premier global community for families to share information and intelligence. His team works with a selected group of top-tier investment managers and sponsors who offer substantial families access to stellar investment opportunities. Maxwell excels in presentation skills, international sales, business development, and business coaching. Maxwell, please tell us more about yourself. What is your story?
Yes, cool. Thank you so much, Peter. Thank you for having me. So I'm from Australia, and I just want to explain a little bit like what a family office is, because not a lot of people know exactly what it is. So a family office is essentially a family that's created quite an amount of wealth, and it's usually a business owner. So usually it's an 8-figure amount of wealth. Usually starts at about 30 or 50 million. And because they've got so much wealth in the family, what they want to do is they want to make sure that it gets passed on to the next generation. So they put things like a team in place to manage the wealth in-house, so to speak, so that the wealth, will be managed and passed on and won't be lost, before the next generation. So, traditionally, people used to just give their money to banks to manage their wealth. Whether it's, an investment bank or a normal bank or a wealth manager, a financial planner or whatever. But what seems to be happening is that everyone wants to go direct. People want to directly invest their own money in real estate, or they want to directly invest their own money into the stock market or alternatives, like wine or whiskey or whatever. And that's what the association does, the Family Office Association of Australia. It helps those families to meet each other, invest with each other, share intelligence, also, share if they want to, charity donations, philanthropy, luxury experiences as well is also very popular amongst, families with a lot of wealth. And basically, what I like to do is I like to connect those families to meet each other and also, structure deals and basically make money together, which is always very helpful.
Great. So as location-wise, are these just rich families from Australia that you're helping managing their wealth? Or are there any Asian-based rich families? Because we know that in the last decade, a lot of Asian families have accumulated a lot of wealth. Are these also your clients?
Yeah. So the thing about people who are this open-minded, this successful, they've got this much wealth, is that, they're almost always international. They've got investments in America, they've got investments in the UK, they've got a favorite property in different parts of the world and their favorite cities. So it's all pretty much international. I've got people that I speak to regularly from London, from Miami, from even parts of Spain, as well as, Singapore, Hong Kong, Australia. The world is so globalized now that it's pretty uncommon to really only do business in one place, only have exposure to one central economy.
Mm-hmm.
So it is global. It's if you jump into this space, what you'll find is that you'll very quickly meet people from all around the world really quickly.
Okay. Would you say that these are mostly families with old money, or also some of your clients have made money recently, like last decades or so?
Yeah, really good question. So I don't know the exact numbers, but statistically, old money basically disappears by about the third generation. I think it's something like 70%. I don't know the exact numbers, but it's in the ballpark of say 70% lose it by the third generation. So statistically, old money doesn't last very long, and statistically, anyone that has 30 or $50 million in their bank account now, or they want to invest like a 30, $50 million investor, because we help them as well. If you have $5, $10 million, I have conversations with a lot of those people as well. It's mostly new money, and what usually happens is a liquidity event. So liquidity event, most people laugh. It's either a divorce or a sale of a business, So when you sell a business, or when you sell, a series of properties right now, you even downsize your property. If you worked hard, you've been a mid 6-figure salary, and there's two of you, and you own a property in a nice house in a in a premium city, cost wise, like New York, Singapore, Sydney, London, Hong Kong, San Francisco. Yeah, you're probably in the $5-10 million range pretty easily, when you sell that property. So a lot of it's new money.
Okay, that is goodness. Do you have any recollection from or events that you can talk about? What is the difference how the new money invests and how the old money invests? Is there still old money is all about property and new money is more like technology, fintech, and similar? Or would you say that the new money is also trying to diversify in real estate?
Yeah, so there's a report that I read once from a group called KKR, which is like a research body. It's the research body for high net worth individuals. And in the report, it said that up to 54% of a high net worth, someone worth, say, $10 million or more, a high net worth individual is has their money in alternatives. So an alternative is, basically not traditional real estate, probably more a bit like commercial real estate or like a hotel or, something like that. Or it's, a mobile home park, or maybe it's something very, very alternative, like investing in cannabis, in arts or classic cars, or, gold and silver and things like that. So yeah, up to 54% of their portfolio is non-traditional investments. So that sort of tells you about how these people like to invest. And it makes sense, because when you invest in the world that's non-traditional, you get non-traditional returns. And also the profile and the risk is it also in generally less correlated to the traditional economy and the traditional market. So for example, if you don't want all your eggs in one basket, then you want to have your eggs in some in the traditional economy and some also in the alternative economy.
Would you say that these alternative investments are more future safe than classical like property market?
It really depends, because I really believe in I love finding pockets of opportunity, so I love not just buying like an index or not just buying like an ETF. I love, if I'm going to buy into stocks and shares, I'll look at specific companies within a specific sector and see if I can, put my money more intelligently than just blanket investing into the broader stock market. So when you go that granular, it really depends on the asset class. For example, let me give an example. So whiskey, right? Whiskey. Last year, I was reading from the Scotch Whisky Association that exports for Scotch whiskey increased by 37%. Right. So that's huge. So that's, more than one third. What that means is that, there's at least more than one third people that want to drink this stuff overseas. And usually when you export stuff, it's a lot more expensive than when you buy it at home. So they're not just drinking more of it, they're willing to pay more of it. So what does that tell you? That tells you that there's huge appetite, huge demand, and, the production capacity for this type of asset is very limited. It's limited usually from a legal regulation perspective. It's limited from a land production perspective. These places only have so much land. Scotland's not a big country, right? And so you want to look at. I'm really interested in looking at those types of numbers. What do those types of numbers point towards in terms of where the opportunity is for the future, like a future-proof opportunity?
Okay. Would you say that family offices use more leverage than investment firms or less leverage?
Good question. I don't know, to be honest. I haven't really spoken to that many about leverage. I don't know, but what I do know is that, a really, really sophisticated investor, usually the more sophisticated they are and the more experienced they are, the less risk they want to take, and they might see, for example, investing in Australia compared to, another part of Asia is less risky just because of the broader economy and because it's an island, things like that. So they look at, they find places where they're really comfortable and they pretty much stay in their comfort seat. They don't like taking unnecessary risk. They don't like trying things for the first time. Usually they sort of, take one foot in front of the other at a time to sort of broaden their comfort level, or they'll invest a very nominal amount. They usually won't read a book about crypto and then put all their money into it, next week. It's usually one that they usually really, really don't like risk. And they usually see things very long term as well. So for example, I was talking to one investor and he's very, very comfortable financially. He's so comfortable that he's just sort of doing a bit of a hobby in terms of what he's doing, and he still wants to grow his wealth. And his investment plan he was sharing with me for him and his family is 40 years. They only look at things from a 40-year horizon, so they're very, very patient. Yes, they want very, very great returns. They don't just want 4% a year for 40 years. They want at least 15% a year for 40 years, but they're willing to wait 40 years until they cash out, so to speak.
I would also like to ask you, do you think you mentioned that family office is just basically a step away from a classical bank and bank investment? Do you think that the trust in banks have really fallen sharply in the last decades?
Wow, you're asking me very, very controversial questions. I don't follow the whole bank. I used to work for a bank, so I don't follow the whole bank thing very much. Like the trust in banks and financial sector and fintech and that sort of thing, it doesn't really interest me. But what I do think is that, everywhere you look in every industry, basically what's happening is people are finding a way to cut out the middleman. So bank used to be a middleman for most people's investments. But, a family taking control of their own wealth and opening up a family office takes away, cuts that away. They've taken control over it and they're willing to pay a salary to manage it in-house. So, what I think in terms of the world is I think that if you can cut out the middleman and add more value to the end consumer in any industry, that is an advantage, whether it's in technology or online or space or education or energy or whatever.
So basically what you are implying is that banks just do not add value like they used to.
No, I wouldn't say that. There are things that banks are very useful for. For example, like so I'll give the only numbers I know are in Australia. So in Australia, what I know is that if you were to borrow money to go buy a house, right? Only 3 out of 10 Australians qualify for a bank loan right now. And usually 7 out of 10, they either don't qualify or they prefer to use a broker. So it's not that banks don't add value. It's just that, for example, a broker works commission only, right? So a broker will work harder for you, will work faster for you. They're they're like a real estate agent. They only get paid when the house is sold. They don't get paid a salary. So if you don't get paid a salary and you're working on performance, you perform better because you have to. Otherwise, it doesn't work for you, and then you'd rather have a job with a bit more job security. So there's different ways to add value. It's not just in reducing costs; it's also in providing better service and having your fee structure aligned with that.
Okay. Regarding investment, do family office invest more in arbitrage business where they make a difference, for example, between rent and the interest rates? Or do they prefer to invest in businesses where there's an added value for the client?
It depends. You got to remember that family offices are just like any other human being on the planet. Some of them have their preferences. Some think long term, some prefer short term, some prefer capital growth, some prefer income. But, everyone loves a quick win, and that's what an arbitrage is. It doesn't matter whether you have $1 billion or you don't have a lot of money, you love a quick win. If you can put your money into somewhere and get it out within 30 days and make 10 cents on the dollar, why would you not want to do that all day long? So that's another key advantage. If you could provide a quick win to someone, you'll get the attention of a lot of people, whether they have a lot of money or not a lot of money.
Okay. We already spoke or touched this family office with private banking and banking a bit. Do you think that the family office is the next evolution of private banking, or do you think that just service or structure all on its own?
Yeah, I think that if it keeps going the way that it's going, a lot of sort of not the biggest banks, but a lot of like the mid to small tier banks won't have any money to manage because everyone will just be managing it themselves, and there's also a huge market, there's a lot of people that prefer to hire a financial advisor. They don't want to manage their own money. They don't want to think about it. They just don't like it. So there will be some, but it's you just got to think about it, right? If you're someone that has $10 million in the bank account, who's going to care more about that money? Someone else or you, right? And where you manage it, how you manage it, and that sort of thing. So, for example, I know a lot of families right now that they will only invest in, for example, someone that has like a fund if the person or real estate or whatever, if the person has at least 50% of their own money in it, so of their net worth, right?
Skin in the game.
Yeah, skin in the game, and it makes perfect sense because, for example, a financial advisor, depending on which country you're in, but most financial advisors usually don't take fees because they don't want to see that as like being biased. But like they don't take performance fees, or they don't take percentages of the money under management, but they'll take like just like a like a service fee, I don't know, $100,000 a year or whatever.
Mm-hmm.
And it's like, how much do they really care, right? Because they're not making more, they're not making less. They're sort of just transactionally, checking out the bread as it goes through as they go to pay for the bread. They're just checking out the products. And yeah, it's their job to care, but if they were aligned, would they care more? Probably.
You already mentioned that some of the families want brokers or managers to have skin in the game. Would you say that one of the advantage of your family office is that many families can invest in a same project or product, so that they basically share the risk and invest maybe just 20% of the project, not the whole project, so that they just get 1/5 of the whole project instead of investing in the whole project. Would you say that that is one of the advantage of the family office and the exchange of information, that people just get access, or the families get access to invest in other people's projects that were already vetted and due diligence is done and secured and everything?
Yeah, really good question. So, that's very smart. Like, for example, if I'm really good at building hotels and I built 7 hotels profitably, and I wanted to make more friends and I didn't really care about money anymore, why would I not include 4 other families into this next hotel? Reduces my risk and helps me make 4 really good friends. Because if you show someone how to make money and helps me to build 4 really good relationships on a really strong footing. And also that's who people want to invest with. For example, if you are a family and you want to invest in the hotel market, who's the best person to ask? Is it your banker, your financial planner? Is it a real estate agent that sells hotels, or is it another family that's done it 7 times before? So who would you rather put your money with? So there's a lot of value in those direct co-investments. Absolutely. Yeah.
Okay. When I was working in private banking, one of the biggest issue we had was indemnity insurance. We could never get indemnity insurance for advising on investment decisions. However, we could always get indemnity insurance for project management. How would you say that the family office or the managers that family office hire get their indemnity insurance? Is that still a thing? Because this was about 10 years ago when I was in business. Is that still a thing that the managers cannot get an indemnity insurance for the investment that they propose?
I have no idea. So I'd rather not comment on that, just because I don't want to misrepresent anything. I have no idea. And there's a few reasons why, because, everything's different in every country. Mm-hmm. For one thing, so, my experience might not help anyone listening to this, but, so another key thing that we do in the Family Office Association is we don't just show families how to make more money. We also show them like the best people to work with, in terms of accountants, lawyers, international accountants, tax accountants. And that's really important as well, because just like in any industry, there's people that are really, really good. There's people that are less good, and people that are less good, and people that are less good. And when you just want to work with the best and you're willing to pay for it, you want someone to help you, introduce you to that person. So that's another thing that I would sort of go to my network for to help answer that question, because I have no idea. So that's a perfect example of how we help each other in this association.
And you also believe that someone that will recommend someone has profession like a lawyer or accountant has already worked with it or with them, or has a first-hand experience with that. So there is a vetting process that has already been conducted.
Yeah, there's very little things that haven't been done before, right? So, I'm a really big fan of, if I want to do something, that I've never done before, either get someone to help me that really knows it and just pay them, or cut them in on the deal and then have them work alongside me, or find the best and then, work out a way to hire them, because it's just, when you've had a lot of deals and a lot of business sort of, I wouldn't say go wrong, but like end up being something that you didn't think that was going to happen. You got the best case scenario in mind, and then it's far from that. Like, you just learn to just work with the most professional person for that particular, to solve that particular problem as much as possible.
Yeah, the best is always the cheapest.
Yeah, exactly. That's a perfect way to put it. The best is always the cheapest. I've always learned that.
Okay, so I would like to ask you about your project. And that is wine investment and whiskey investment, because I really like the idea. How you come to this idea, it seems genius to me. That you would turn a fast-moving consumer good like wine and whiskey into a financial product. Was that just spontaneous idea? You said that you analyzed the growth of the market, and you know that the production facilities take so long to build, and if the market is growing so fast, that there's certainly an opportunity there.
No,
Or did you? Sorry.
I'm not that smart. So I'm
Or
not the
did you
that works that
think
out.
in terms of asset class, and you said, okay, I'll need an alternative asset class, and then you said, okay, I'm gonna make whiskey and wine alternative asset class.
No, I didn't try to fit anything into anything. I probably had the exact same interest as you. So when I first heard of it, I thought, wow, that's really interesting. I wanted to learn more. And then as I started to learn about it, I thought, wow, this makes a lot of sense, and then I started to look at the market. For example, in Australia, it doesn't really exist. So, we're pretty much the first to bring it to Australia in a big way.
Mhm.
And but it just makes perfect sense. So, for example, everyone's been to, a nice restaurant, they open up the wine list. You open up the wine list and you look at, sorry, you look at the same bottle of wine just from a different year. And you look at the price difference, right? The price difference is usually, at least more or less 15, 20% difference. It's the same bottle, just a different year. So just so people know, that bottle was just sitting in a warehouse, in like an Amazon warehouse or a cellar or, in a underground for just an extra year, and whilst it was sitting there, it was insured, it was valued, independently valued, independently insured. And, it appreciates because, fine wine ages in the bottle. So it's like the age old saying, age is like fine wine. My personal experience of when I've actually paid for the difference by accident, I was in a bar in Chicago and then I wanted to drink an old fashioned. An old fashioned is usually made either with whiskey bourbon or Scotch whiskey. I said I wanted Scotch whiskey, and the guy said, great, would you like to have Macallan 12 or Macallan 18? Macallan is like the Ferrari of Scotch whiskey. It's very, very famous. Everyone knows it. It's premium and higher end. And I thought, I'm on holiday. I'll pick the 18. Why not? So I drink it. It's delicious. Never had an 18 before. 18 means it's 18 years old, right? And I said to the bartender, wow, this is amazing. How much is this? And he said, 125. I said, no. Not how much is the tab so far. How much is this drink? And he said 125. And I thought, wow, shit. Well, I'm committed now, $125 plus tip. That's a lot of money for a drink. And I said, how much was the 12? And he said 25. I thought, wow, and obviously this is a very specific example. It's top end of the market, but the return, the margin is still there. 6 years of aging, it just sat in the warehouse for 6 years longer, and you're looking at a 500% return. It's pretty hard to buy stocks, shares, property, anything that can generate that type of return. And what I love about these assets is that they're in a perfect life cycle. So they age, someone drinks them, then it starts all over again. There's never more supply than demand, because it takes 10, 20, 30 years to make this thing and 10 seconds to open it, and then it's gone, right? And then you have to start again. So it just like the scarcity value is just on a constant sort of wheel that just spins over and over and over and over again. And consumption isn't slowing down. I think I shared that last year, the Scotch Whisky Association reported that exports out of Scotland increased by 37%. 37%, more than a third. So you got people who are not just drinking more of it, but also willing to pay more, because, if you're importing Scotch whiskey from any other part of the world that isn't Scotland, isn't the UK, usually the taxes and duties are more. For example, 49 cents on the dollar in Australia is what you pay. Not even including import costs, but that's just the sales and alcohol tax. There's in the same article, it said that in India, they've reduced the duty for alcohol, the Scotch whiskey in India by 150%. So some of the stock might even be less than half of what it was. So imagine how much more will be drunk then, right? And there's no more supply being made really compared to the demand. So I think the fundamentals are excellent. The asset is obviously fun and exciting to learn about. I personally enjoy it. Not just because, it gets you drunk, but I personally enjoy it because it's what you do when you spend time with people that you love. At a wedding, what do? You toast with champagne. You drink wine, you toast. You haven't seen friends for a long time. You buy a nice bottle of wine. You haven't played poker on a boys' night for a long time. You have some whiskey. It's all about having a good time. So it's like this perfect luxury good that just adds value to pretty much every part of my life.
That's nice. So I really like that concept that something that you invest you can also enjoy. So it's not just paper; it's something that you can actually touch and use. That is really huge advantage over some paper money or features or stocks or whatever you would buy, because you could only enjoy it when you liquidate it, and then only then you could enjoy the money that you made. Let's get into more personal things. What do you attribute your success to? You're extremely successful both in family office and in investments. What would you say that is the most important thing that made you successful?
Oh, good question. I don't think I have this. I think about this a lot, actually. I don't think I have this mastered. But I think the thing that makes people, the number one reason why people aren't successful is not because of money, time, not good looking enough, tall enough, short enough, smart enough, whatever. It's a lack of self-awareness. And so what I mean by that is, I see a lot of entrepreneurs. I used to do coaching for a lot of entrepreneurs, and they would make the same mistake 100 times in a row, and the only reason why they kept making the mistake is not because they like to make the mistake. It's not because they had more money to burn making the same mistake, but they just literally weren't self-aware of the pattern that was happening so that they could learn from it, So I believe the most successful business people on the planet are extremely self-aware. They're self-aware enough to the point where everyone makes mistakes, but if you're self-aware enough, you only make it once. And that allows you to move so much more faster than if you made it even twice. You're moving half as fast. Does that make sense? Even if you make the same mistake just twice compared to once.
As a coach, do you help people identify their mistakes?
Yeah. So, people pay me, they used to pay me a lot of money, and, I've actually just signed a few clients that have asked me for help from my old business. That's, would basically pay me to help them see their mistakes, to help them move faster, and unfortunately the coaching industry, there's a lot of people that aren't good at what they do, or they don't deliver what is promised. So the industry sort of has a bit of a, because it's unregulated, right? Just like crypto and stuff, it's a little bit messy. Like there's good operators and not so good operators. But when you find a good operator who has done it before, they've got a track record, they've had success before. That means they don't just know the theory, they've put it into practice, and they know how hard it is for you to put into practice, so they can help you to do it, right? So, for example, if you want to play tennis and beat, Roger Federer, you want to learn from someone that used to play tennis. You don't want to learn from someone that just read all the books about tennis, right? So it's the same thing in business. If you want to if you want $1 million business, talk to someone that has built $1 million business. It's that simple, right? If you want, I've never built $100 million business, so you can't talk to me about it. But there's people that have, so talk to them. I can help you with $1 million business, but $100 million business, I'm not there yet. So it's that simple. But a lot of people, I think, miss that, or they trip over that, or they unfortunately sort of get overpromised from people that aren't necessarily able to deliver what they're looking for.
What would you choose as a coach? What would you recommend, and what was your life choice? Would you choose grinding and working really hard, or would you recommend more balanced life and let it go, as French would say, laissez-faire, and more like Italian dolce vita approach? You mentioned that you like to drink a bit of whiskey, a bit of good wine. Where is this the right balance between grinding and dolce vita?
Okay, good question. I don't think personally that there is such thing as a black and white balance. I think that there's times where you want to work hard because you need to work hard, but you, more or less, you want to, and there's times where you don't need to. For example, I heard this quote, I think it's from Warren Buffett, and he said, sometimes you might wait 10 years for the perfect thing to, like a perfect deal, the perfect investment, the perfect business opportunity, the perfect opportunity, whatever, to come along. But also, you might do 10 years worth of work in a week because the perfect opportunity is here and it's happening right now, whatever. So I think it'd be foolish to say, oh, I only work 2 days a week and that's my life, black and white. But what if someone said to you, look, this opportunity is here. You got to work 10 days in a row to get it across the line. Are you going to walk away from that or not? It's a bit like the Eminem song. If, the world gave you like one shot and one opportunity, whatever, would you take it? And I always believe, yeah, you should take it. And it might ask you to lift up your game for a month, for 3 months, for a year, but then that creates all the difference, right? So, if you look at any ultra successful person on the planet, none of them have said, oh yeah, I only work 2 days a week and that's my life promise to myself. They might work 2 days a week now, but to get there, they had a trade-off. I'm gonna be the best, be in the gym, I don't know, singing songs, writing songs or whatever for 5 years, master my craft early, then retire from it. Generally people don't really master their craft slow. Because if you're that passionate about something, you wouldn't be doing it slowly. You wouldn't be doing it 2 days a week.
Okay. Is there anything you would like our listeners to take from this interview? Any quick tips of the trade or anything secrets that you can share?
Don't be afraid to reach out to people. I do a lot of podcasts. I made a commitment to basically do at least one podcast a week. I think I'm averaging that. And I tell everyone, message me on LinkedIn if you have a deal or anything you want to talk about, or anything I talk about they're interested in. And almost no one messages me because people just don't take action. So it's that simple. Just take action, whether it's message me, whether it's, talk to Peter, whether it's, apply for that job that you've always wanted, but you're sitting there sort of not going for it. Like just take the action.
Okay. I will put links where listeners can reach you in the description below. Thank you, Maxwell, for being my guest tonight. And hope that we got something really good from this interview.
Yeah, perfect. Nice. Thank you for having me.
Thank you, Mr. Faleskini, for this outstanding podcast. And thank you for listening to the Ask Faleskini podcast until the end. Mr. Faleskini would love to hear your feedback in the comments. And don't forget, if you want to know, ask Faleskini or listen to the Ask Faleskini podcast. In order to please the almighty algorithm, please don't forget to like, share, and subscribe.